Michael, good to have you back on the close on Street Smart. Matt's down on the floor. He's talking to Teddy Weisberg, and Teddy says he's trying to decide between a gun and a rope when he looks at these markets. Are you that desperate when you look at the outlook here?
Heavens, no. The only thing I'm desperate about is a gun or a rope for the knuckleheads in Washington who can't figure out this debt limit problem. But beyond that, no. I mean, the markets are behaving actually fairly rationally, in our opinion. There are some long-term issues that have to be resolved. There's some short-term issues, certainly like Europe and other places. But we think the market's going to continue to sort of mark time and continue to really spend a lot of time going nowhere.
Well, that's interesting because we actually talked, Michael, to Wharton finance professor Jeremy Siegel earlier. He's a longtime proponent of stock buying, very upbeat here. He gave us his short-term outlook for stocks. Listen up.
If we get this rebound from those temporary high gas prices, the earthquake tsunami in Japan, and several other features, I easily can see 10 to 15%. The market is just so cheap.
So, Michael, you say we're maybe going to be marking time here. Jeremy says we could see 10 to 15% in the next 6 months. Do you think he's just crazy here? I've got some viewers writing in saying he's just missing it here.
No, I mean, I would only say that if Chicago had the Philadelphia Phillies pitching staff, the Cubs would win the World Series. These are real issues, right? These are real problems. They're not going to get over them quickly. The markets certainly aren't. He is right about one thing. The market's inexpensive. But it's inexpensive for a reason, and typically valuations don't drive market movement. They'll tell you how far the market can run, and if corporate America continues to report good quarterly earnings, which we expect this quarter, another decent set of earnings, we could get some upward revision eventually. But, we've got to get this huge overhang of bad news away and behind us, and I just don't think it's going to happen anytime soon. Our big problem starts with housing, and it ends with unemployment. And until those two things get taken care of, we're going to have a tough time.
You say, Michael, gold is the insurance policy for crazy government intervention. And these are two places, housing and employment, where the government can't help but to intervene, right? I mean, whether they do good or bad, they're going to get in there somehow. Do you keep buying gold here? I mean, we're looking at $15.69 right here, pretty pricey.
Yeah, no, it actually looks pretty interesting to us. I think so the fundamental rationale for gold is this. If the Federal Reserve, if things get bad enough, if things get ugly enough economically, if the slowdown continues and we get a rebound in gas prices and Europe continues to implode and so on, if the markets fall 10 or 15%, you're going to see a significant stimulus from the Federal Reserve, some way, shape, or form. If that's the case, the way to hedge yourself there, if you're conservatively postured like we are, is to own some gold. And because gold is going to be that canary in the coal mine that tells you when they're going to continue to weaken paper and fiat currency. So, we're not normally a gold bug, but at the end of the day, or certainly at the end of this day, we think gold is a reasonable place to be as an insurance policy against further debasement of the currency.
Hey, Michael, I got to talk to you about the auction today because it was surprisingly positive. You look at the 3-year. This was the first auction that happened without the Fed. There was no QE here. All right. And take a look. 3.2 bid to cover. That's better than what we've seen in the past, 3.17. Smallest dealer takedown since January. The yield was 0.67. It was 0.68 before. So doesn't that argue for a market taking a lot of this in stride? And if that's the case, do you really need that much gold in position?
Well, I don't. The answer is the Treasury market actually looks reasonably comfortable right here, mostly because there's such weak and punk economic activity. Right? The Federal Reserve came out in their minutes again and said that they expect to keep short-term rates low, extremely low, for an extended period of time. So this sort of slaughter in the bond market that people have been talking about for the last 18 months is at least 18 months away, if not 36 or 48 months away, before the Federal Reserve really begins to raise rates. So in that case, what's the danger in buying a 2 or 3 year note or a 5-year note? Potentially a little more worrisome in the 10-year range. But again, we're talking about interest rates that have that are low and will remain low. We would love nothing more than to see higher interest rates. Higher interest rates generally are a sign of two things. One is, of course, the negative, which is what you're seeing in Europe, that is higher credit risk. But we think more likely U.S. government rates would be higher if there were good economic activity. That means demand for money is strong. That means demand for production, for capital investment is strong. And right now we're not seeing that, hence the really, really weak Treasury market.
Hey, Michael, it's Julie here. I want to bring back in equities, and I want to talk specifically about corporate earnings. It's something that Teddy Weisberg just brought up a few minutes ago. It's something that a lot of investors, you referred to it. You know, when you look at the season, there's a lot of optimism out there. And I was just talking a few minutes ago about a couple of smaller semiconductor companies, Microchip Technologies, Novellus, which is a chip equipment maker, both of them coming out with negative forecasts. And Microchip in particular really making some comments that seem to have implications for the broader industry. Weakness in the automotive industry, weakness in consumer, weakness in PC clients. I mean, something like that, isn't that kind of a red flag when we go into earnings?
There's two problems with earnings announcements on any individual company. One is, if they have a problem, like Microchip did today, it's impossible for any but the most astute analyst to be able to tell you if it's a company problem on execution and their market share and their production process, or it's an industry-wide problem. But one thing's for sure, they will always blame it on an industry-wide problem. So the question is not just Microchip, but it's others as well. What else is going on in some of the technology areas? And I'm not an expert in microchip technology by any stretch. But the problem is it's very difficult to tell one earnings announcement at a time what's going to happen. I'm certainly willing to give the benefit of the doubt to a positive earnings estimate revision and positive earnings beats this quarter. There's certainly no reason why we shouldn't see really good growth across the board in most industries, except financial. We expect financial to be quite weak. But generally, we should see pretty good earnings estimates. And as a result, I think, again, the market's going to have a floor here, is the basic promise. But we don't see any catalyst for upside, given all the problems that are out there on the horizon.
And Michael, just to be clear, for our audience, I mean, you're not a bear here. You're not bearish, but you're going to say it's going to be tougher and tougher to make money. So where are your favorite spots right now to make money in this environment?
So actually, we are overweight the U.S., believe it or not, after what I just said. We think the U.S. is
why? Because it's just better than the rest, or less bad here in the United States?
It's the best of a bad lot, as they say. No, I mean, look, if you think about the three pockets of equity interest, you have emerging markets. The problem there is that they're all raising interest rates, which is a difficult thing for local currency or local equity markets. Obviously, in developed equities, you have mostly Europe. That's a real problem at the moment, as is Japan. So we actually like the U.S. It's stable. It's high quality. We're going to generate reasonable earnings estimates and earnings reports coming this quarter. So we are underweight risk assets in the equity markets in general, but we have a modest overweight in the U.S. relative to the others, if that makes sense. So,
But you only hold 25% equities, right? I mean, you're pretty broadly allocated here. You're holding 25% fixed income, 25% commodities, 25% real estate, currencies, and cash. Really?
Right.
Why?
Really?
Why?
Well, it's the portfolio isn't quite that simple. It's actually a lot more complex. But the objective is to sort of figure out where we are relative to risk. And as I've said before, we are underweight risk assets, and we're overweight conservative assets. And we think gold and non-risk assets, fixed income, gold, certainly some conservative currency investments are the majority of the portfolio at the moment. And we're underweight most risk assets, including agricultural commodities and including energy and including emerging and developed international. So we have a slight overweight in U.S. equity.
Got to run. Michael,
a lot of moving parts.
Sounds like it. Michael, always good to get some time. You take care. Michael Vogelzang joining us.
Thanks, guys.